Age Pension Explained. Common Centrelink mistakes that can affect your payments. Are you about to apply for the age pension? Or maybe you're already receiving it? Well, stick around because the mistakes I'm about to share with you could be costing you thousands of dollars. Applying for the age pension through Centrelink might seem straightforward, but the truth is, even small errors can lead to massive delays, reduced payments, or having your application rejected completely. In this video, we're going to walk through the 8 most common Centrelink mistakes that affect age pension payments. We'll cover exactly what goes wrong, why it happens, and most importantly, how you can avoid it. Let's dive in. Mistake number 1. Getting the timing wrong. Mistake number 1 is all about timing, and honestly, this is probably the most expensive mistake you can make. Here's what happens. A lot of people assume that once they turn 67, the age pension age, Centrelink will automatically backdate their payments to when they first became eligible. Wrong. Centrelink only backdates payments to the day you actually lodged your application or the day you became eligible, whichever is later. So let's say you turn 67 in January, but you don't apply until December. You've just lost almost a full year of payments. For a couple, that could be upwards of $46,000. Gone. The solution? Apply early. You can actually apply 13 weeks before you reach age pension age. Mark it on your calendar. Set a reminder. Do it now because waiting costs money. Mistake number 2. Incorrectly valuing your assets. And this trips up so many people. Centrelink asks you to list your assets at their current market value, not what you paid for them, not what they're insured for, what you could sell them for today. Here's where people go wrong. They'll list their car at the purchase price, say $35,000. But realistically, if you had to sell that car tomorrow, it's worth maybe $12,000 as a trade-in. By listing it at $35,000, you've just made your assets look much bigger than they really are. Same with home contents. People insure their furniture for $50,000 and think that's what they should tell Centrelink. But the current market value of your lounge suite, your TV, your kitchen table, for most couples, it's between $10,000 and $30,000 total. Overvaluing your assets can push you over the asset test limit and reduce your pension. Be realistic, be accurate. Mistake number 3 is probably the most common error I see with superannuation. I call it double counting. Here's how it works. You have your superannuation account. You declare that balance as an asset. That's correct. You absolutely must do that. But then people also declare the income they're drawing from their super as income. And that's where the problem starts. Centrelink uses something called Deeming. They look at your super balance and they apply a deemed rate of return, currently 0.25% on the first chunk and 2.25% on anything above that. That's the income they count for the income test. If you also declare your actual pension drawings as income, you're effectively counting that money twice. Your application will look like you have way too much income and it will likely be rejected. The rule? Declare your super balance as an asset. Let Centrelink do the deeming. Do not declare your account-based pension payments as separate income. Mistake number 4. Submitting incomplete or incorrect documents. Mistake number 4 is about paperwork, and I know paperwork is boring, but getting it wrong can stop your application in its tracks. Here's something crucial to understand. Centrelink does not start assessing your claim until all required documents are received. If you submit an incomplete application, it just sits there. No assessment, no payment, nothing. What documents do you need? Official bank statements, not transaction printouts, but actual statements with your name and account details. Tax returns, notices of assessment from the ATO, superannuation statements. And here's a trap. A transaction list, not acceptable. It needs to be the official statement. Before you even start your application, gather everything. Have it all ready because every missing document just adds weeks to your wait time. Mistake number 5. Forgetting dormant financial structures. Mistake number 5 catches people who have businesses or investments. If you have an interest in a private company or a trust, even if it's completely dormant, not trading, no money moving, you must declare it. Centrelink needs to know,
and you'll likely need to provide tax returns and notices of assessment for those entities as well. Dormant doesn't mean invisible. If it exists, declare it. Failing to do so is a fast track to having your application rejected. Mistake number 6, failing to report changes. Now, what about after your pension is approved? Mistake number 6 is all about ongoing obligations. Once you're on the age pension, your responsibility doesn't end. You have a legal duty to tell Centrelink about changes in your circumstances within 14 days. What kind of changes? If you start a part-time job, if your partner's income changes, if you sell your house, if you receive an inheritance, if you move address, if you go overseas, anything that affects your income or assets needs to be reported. If you don't report, you'll likely be overpaid, and when Centrelink discovers it, and they will discover it, you'll have a debt to repay. It's stressful, it's avoidable, and it's entirely within your control. The easiest way to report? Through your Centrelink online account via MyGov. It takes 5 minutes. Mistake number 7, overseas travel errors. Here's a real story that actually happened. A pensioner went overseas for an extended stay. He needed to provide a proof of life certificate to keep getting his payments. His son, trying to help, completed the form. The problem was the son wasn't an authorized certifier. The rules require certification by a medical practitioner, a notary public, a police officer, or someone from an Australian embassy. The result? His payment was canceled. Months without pension while he sorted it out. So before you travel, especially for long stays, understand the rules. Contact Centrelink the day before you leave Australia. And if you need to certify documents overseas, make sure it's done by an authorized person. Mistake number 8, SMSF mistakes. If you have a self-managed super fund, you have additional responsibilities. You need to declare the fund's assets at market value. If you're drawing a regular income stream from your SMSF, Centrelink considers you're receiving a pension, just not the age pension. You'll likely need a specific member statement, often called an SA-330, to verify these amounts. Common SMSF mistakes? Not declaring the fund at all, incorrectly valuing assets, missing required documentation. If you have an SMSF, get professional advice before applying. Now, what if you do everything right and still get a decision you disagree with? You have rights. First, contact Centrelink and discuss it. If you're still not satisfied, you can ask for an internal review by an authorized review officer, someone who wasn't involved in the original decision. Request this review within 13 weeks if you want to protect your right to backdated payments if the decision is later changed in your favor. If you still disagree after that, you can go to the Administrative Review Tribunal, the ART, which is an independent body. Don't be afraid to challenge decisions, but do it properly and do it in time. Free help available. Before we wrap up, I want to tell you about a free resource that most people don't know about. Centrelink has something called the Financial Information Service, FIS for short. These are qualified financial specialists who provide free, independent information. They're not selling anything. They're not aligned with any bank or product. They're there to help you understand the rules and make informed decisions. You can book a confidential appointment. It could save you thousands. The number is on the screen now, and it'll be in the description below. Summary and key takeaways. Let's quickly recap the 8 mistakes so they stick. Number 1, applying too late. Apply 13 weeks before you turn 67. Number 2, overvaluing your assets. Use current market value. Number 3, double counting super. Declare the asset. Let Centrelink do the deeming. Number 4, incomplete documents. Gather everything before you start. Number 5, hidden structures. Declare all companies and trusts. Number 6, not reporting changes. Tell Centrelink within 14 days. Number 7, travel errors. Know the rules before you go. Number 8, SMSF mistakes. Get the documentation right. Look, the age pension system is complex, but you don't have to be an expert to get it right. You just need to know the common pitfalls and avoid them. If you found this video helpful, please hit that like button. It helps other seniors find this information too. And subscribe to the channel for more videos on retirement, pensions, and making your money work for you. Got a question? Drop it in the comments. I read them, and I might make a video answering your specific situation. Thanks for watching. Take care of yourself, and take care of your retirement.